Seems every second news article at the moment is the fact that interest rates are on the rise. Panic, fear. And I think because of this, a lot of people are questioning, should we be fixing our interest rate to stop these increased payments month after month? Or should we be leaving it variable? So today I want to tackle that exact question. So should you fix or should you leave it variable? Now, first and foremost, I don't know your financial situation. Depending on your situation will factor into what you should do. But I hope what I run through today gives you some things to think about, because the difference between fixing and keeping your mortgage variable can be huge. And I really want to highlight that at the end of this video, so make sure you stick around. And if you are new to this channel, make sure you subscribe. We bring out a heap of money tips and we love talking about property investing. So jumping straight into it. The main reason people fix their mortgage is to have consistent monthly payments and in an attempt to save money. Wasn't that long ago that the actual fixed rates were considerably lower than the variable rates, and that did create a bit of a unique opportunity. So there is that element of saving money through a fixed rate, and that's a big part of this video that I want to focus on today. Before I jump into that though, there are some things that you really need to consider before you fix your home loan. The first thing is, if you do fix your home loan, you really are limited as to how much you can pay off that loan. Each bank or each account will have a different policy. Each loan will have a different policy, I should say. So check in and make sure you work out how much you can actually pay off your loan in advance if you do decide to fix the whole portion of your mortgage. The second negative is you are going to be stuck with that bank for that period of time unless you pay some huge exit fees. And the third negative, if you do decide to fix your mortgage, it can really impact your ability to access equity. Back in 2019, I think it was, time has a funny way of distorting itself, but back in 2019, I believe, me and my wife went and bought a duplex in Cairns. And we were going through the loan approval and we decided to go with the ANZ, as we did have a number of fixed mortgages with the ANZ and we were wanting to take out equity out of the properties that those mortgages were secured against. We got through the process of lodging our application, providing our income statement, yada, yada, yada. And the ANZ turned around and said they had a specific policy with duplexes that you needed a 30% deposit and there was no option there to pay lender's mortgage insurance, which completely squashed this deal. We ended up having to turn this deal around and go with another bank that had a different set of policies, but we did have to pay a heap of exit fees in order to access our equity, and it wasn't a small amount. So keep that in mind if you are fixing your mortgages, is it will limit your access to your equity into the future, or at least for that period of the fixed mortgage. With that quick pros and cons out of the way, I want to jump in and crunch some numbers on basically the forward forecasts of where interest rates might go and compare that to the fixed rates that are on offer to just weigh up which would be the cheaper option. Should you be fixing your mortgage or should you keep it variable? Now, once again, you've got to make your own financial decisions, but maybe a calculation like the one I'm going to run through would be a really good way for you to make up your mind. So let's jump into it. So to jump into this, I want to pull a couple of real life examples from today being the 1st of August. And I'm just going to jump onto the CBA. It's one of the big four. Like I say, run the numbers on this depending on what your bank has to offer. But for the CBA, essentially their current 2-year fixed rate is 5.94%. And their variable is sitting at about 2% north of what the cash rate is. So at the moment, you could get a variable rate with the Commonwealth Bank at 3.39%. So I want to jump into a spreadsheet here. Essentially, I want to run this example. So you fixed your loan with the CBA at 5.94%. You borrowed $500,000, and essentially that's going to cost you almost $2,500 per year. For the 2-year period, you'll pay $59,400 in interest. Now this bit's pretty easy to calculate as we've locked in, we've fixed that rate, we know exactly how much our payments are going to be each month towards interest. Now I haven't included any loan pay down in there. Obviously that's going to make a bit of a difference, but it's sort of a net sum zero between the two, between having your fixed rate or your variable interest I didn't think it was important to include a loan paydown in that, as it's going to work out roughly the same for both of the sums. Now to jump over, this is the one that's a little bit tricky to work out what the variable rate might do. Currently the variable rate's 3.39, but there's a pretty common consensus at the moment that the interest rates are going to rise by 0.5%. Now it's important to remember here there's a difference between the cash rate and the interest rate you're getting charged. Most banks have about a 2% buffer on their variable rate compared to what the cash rate is. So a 0.5% rate will bring us up to a 3.89, and then to look and make some forward predictions. Essentially, Trading Economics puts out an interest rate forecast. Now their forecast at the moment has things increasing to 2.1% by the end of the quarter, and then basically trending around 2.6 through to 2023. And you can see that in their graph here. So we might just start by using this information as the start of the equation. So essentially a 2.1% by the end of the quarter would bring us to 2.14, and trending up to a 2.6 will sit us somewhere around the 4.6 to 4.8. Now jumping over to another bit of a data source, each of the banks are putting forward their forecasts of where they think things are going. The CBA thinks we're going to sit around 2.6% cash rate, Westpac tend to agree, the NAB agree, and the ANZ is the outlier, thinking things are going to hit 3.1 by 2024. So jumping back into our graph, let's say the ANZ's right and we end up at a cash rate of 3.1, which would be a 5.1% interest rate if you're with the CBA, keeping into account that sort of 2% buffer. So we're going to carry that on for the remainder of the 2 years. Essentially, over the 2 years, the interest payable would be just over 47,000, so 47,854. Now, how does that compare to our original fixed rate? So the original fixed rate was 59,000, which means there's an $11,000 difference between what the interest rate forecasts are and what the banks are charging as their fixed rates. So I think this is a really important exercise if you are going to go through and look at fixing your rates. Spend some time and make some forecasts as to where you think interest rates might be heading. And I think at the moment, with the way things are playing out, interest rates would have to go absolutely through the roof and very quickly for the fixed rates actually to turn out to be a better value option. Like I say, I don't know your situation, so make sure you work out the sums for yourself. And it's certainly an interesting point in time where a lot of money can be saved by making the right decision around your mortgage. Thanks for tuning in. If you have enjoyed this video, make sure you subscribe. We bring out a heap of content on this channel around money and around investing. Thanks for watching and have a fantastic day.